Hello, hello. Good evening. Well, today is a slightly different one. I've got one of my friends who's studying accounting right now, so um, he did ask for some help, so I decided, why not record a lesson as well? So this is all live and recorded. So I'm not sure how this will go, but let's just jump into it. Yeah. Let me. Yeah. Okay. Uh. All right. I'm live. You want to introduce yourself, or we can just dive straight into it?
Hello.
Yep.
Hi.
Okay. All right. That's enough.
There
I mean, do you want to introduce a name, or you're fine with just that? Hello.
Hello.
Okay.
Uh,
That's fair. Uh. All right. So today my friend sent me some questions that he's practicing for his upcoming test. So these are all practice questions, and I think I'll. Is it from a book or is it?
yeah.
Uh,
It's from GCSE O level topics.
I see. Okay, yeah. So, for those of you who wants more practice, and you're taking GCO levels, you can go buy the book. But yeah, so these questions are taken from the book. So, yeah. Without further ado, let's start. So today, what we're going through is cost of sales. Um, First we start with the classification of the account. Okay. So, cost of sales is considered an expense, and it is closely tied to something we call inventory, which is an asset. Uh, so for those of you who remember the classification method, right? Uh, so first we have inventory. We call it INV for short, and then we have cost of sales or cost of goods sold. Both of these can be written as COS or COGS. These two are interchangeable. So, okay. So let's start with inventory first because it's more straightforward. Inventory is basically items that you hold as a company or as a person with the intent to sell later for hopefully a profit. So then we can with this definition we can actually kind of classify it properly. So inventory it will have a history because you got it from somewhere, right? That's requirement number one. It has a history. And number two, you intend to use it uh, for future economic benefits, usually by selling it, right? So, uh, sell for hopefully profits.
Okay. I have a question, right?
Yes.
So when recording down inventory,
Mm.
do you record the price you take it as, or is it the current, like, let's say you bought something at
Mm.
a certain price, and then the market of the item goes up? Do you record it as current market value,
Okay.
or do you record it as
Yeah.
taken in?
It's a very good question. For inventory costing, we'll go through the entire costing method later on, but in general, uh, we have basically historical costs, meaning the day um you bought it at. So like on the day you buy, the amount you paid, um I believe you can less out certain parts of it, but that's like the specifics. So in the most basic terms, uh cost on the day itself,
Okay.
on the day of purchase.
So it's the cost that you bought the inventory at, regardless of what the value turns into.
Okay, so that's the second one. Uh you will look at market value. This is a bit more advanced as well.
Okay.
If and you take the lower of the of the two.
Okay.
Okay, maybe this is not the right place to write it. Okay, you see these two criteria, you take the lower amount.
Okay.
Yes. But this is more advanced. today cost of sales, at least the questions you provided me, they are not as bad. At least like the first few questions I've seen. But yes, in general, this is how you should do it. Historical cost, depends on the costing method. It can vary slightly, but market value usually when you evaluate it once a year, or actually like it depends on the company as well. If it's a very volatile good, like volatile value, you actually want to value it more often. So yeah, but regardless of how you do it, you have to take the lower amount of the two.
Okay.
Yes. And if the market value is lower than historical cost, you have something called impairment. Meaning that your goods no longer can sell for, what you bought for, meaning that you have essentially made a loss, even though you didn't realize the loss yet.
Okay.
Yeah.
So let's say I bought a box of toys, right?
Mm.
That's an inventory. I bought it at, let's say, $30. I intend to sell this for let's say a value of say $50.
Mm-hmm.
And while I'm in possession of this box of toy, uh and let's say it gets knocked around, it takes damage, and then I'm unable to sell it for the value of $50. I can only sell it for less than 30, which is, let's give it a like X value of like, I don't know, 25, 20.
25, okay.
Does that count as impairment?
Yes, that counts as impairment. So you have this is what you call net realizable value. Basically, if something happened to this box of toys and you have to spend money trying to restore it to this amount, that is also included in this. So basically, like net realizable value is basically your selling less restoring costs, basically.
Okay.
So cost you, like money you spend to try and make it more sellable, like all that stuff. You less it from the selling. That's a net realizable value. If it's lower, I mean, that means you made a loss of $5, basically.
Okay.
Yeah. But impairment is slightly different. You could see this as impairment, but usually impairment is due to things out of your control, like market changes, things like that.
Okay.
This one, because you have to restore and all that stuff, and net realizable value means that you probably would have sold it already. So usually you recognize the loss immediately. Impairment is basically how impairment works is like you have on one side you have an expense, which if you still remember, when debit increases, right? So then you have something to credit, correct? So what you credit here is actually what they call a contra asset, which is not a liability. It just means you subtract it from the value of your asset.
Okay.
Yeah. So contra asset, the proper name is like accumulated impairment loss. But these are more advanced topics already. Yeah. So not sure if the viewers can actually understand all this.
I don't think I can understand it even if we went on.
Yeah.
So
Okay.
let's
So
stick to the basics.
yeah. Let's go back to the basics. Yeah. So let's just, okay. If you want to take away anything, just take away just the most important part is just lower off either the historical cost, meaning the cost you bought it at, the price you bought it at, and number two, what they call like, I forgot what it is, but essentially market value.
Okay.
Yeah, the lower of these two. Actually, no, sorry, it's not market value, it's net realizable value. Basically, essentially, if anything happened to it, and the cost for whatever reason, uh, and for whatever reasons you can't sell it at the cost, yeah, then you recognize at the lower of these two.
I see.
Yeah.
Okay.
Okay. So, and that ties in very closely to cost of sales because you need to know how to determine how to determine historical cost basically. So, we have two general principles of accounting. One is IFRS. The other one is GAAP. IFRS is used by a lot more countries. GAAP mainly by the US. I believe for GCO levels, Britain, Singapore, they use IFRS, or Singapore is SFRS. So,
What's the difference between the two?
okay. So under IFRS, you can do first in, first out, meaning whatever goods you bought first, you have to sell it first, basically.
Okay.
In
FIFO.
at least when you record it down. Okay.
Right.
The other one is weighted average.
What does that mean?
Basically, you take the average of whatever that is left inside your house after something happened to it. So, for example, if you buy something at a lower cost, your average cost will go down, right? If okay,
Something at average cost.
okay, so if you bought like one apple
Yeah.
and you have one apple in your storage,
Mhm.
right? Okay, so if the original apple costs like $5 and the apple you bought costs $3, when you add it in, you have two apples at $8, and the weighted average will say, you divide by 2 to get $4. So that is essentially weighted average. So instead of you have like uh 3 plus 5, you just lump it together and call it 4. Both cost $4.
Okay.
Yes. So and okay, and JAP has the same for these two, but they also have something called last in first out. This one is not allowed under IFRS, but it's allowed under GAAP. So
Okay.
to make a distinction, only allowed under GAAP. Okay, maybe only here is not good. Yeah, okay, basically that. The double dots means that it's the same thing. You can
Okay.
use it here as well. Yeah. So these are the general ones. There are more specific ways of costing because the world is complex and
Okay.
yeah, basically usually
So
those
it's
the
like
companies have their specific ways of costing lah. So
okay.
you'll learn it when you go in.
So
Right.
we'll be sticking to IFRS, right? I assume we'll be using FIFO most often.
Yes, FIFO or FIFO. First in first out. Basically, uh, this is commonly used for perishables.
Right.
Because
Expiration dates.
yeah.
It's easier to sort with this.
Yeah, and also it makes sense. The
Right.
first thing you buy usually expires faster than something you buy later.
Right.
Yeah, so then weighted average is usually for convenience.
Okay.
Yeah. Alright, so those are the main ones. Last in first out, I'll probably record like a supplementary video for it because it's not the main bulk of it.
No worries.
Yeah.
No worries.
So okay. Then any questions so far? Do you have anything else you want to clarify?
No, I'm good.
You good? Okay. Then in that case, let's go into the first question.
All right.
Okay, so for those who okay, how do I want to share this? Yeah, I'll just copy and paste it into the oh, that's huge. Okay, wait, hold on. Move this like okay. yeah, so this is okay, maybe it's a bit small.
Oh, we can see it.
Okay. Alright, so let's just start with a question, okay, because it's easier. Basically, let's look at the first question, right? 1A. They want you to find out total cost of sales for August 2017. So usually when you have more space, for example, like a whole page, right?
Right.
What you
You
can do is you draw a line first, and then on both sides you write the same thing, date, right?
right.
Quantity. Oh, or you can write QTY for short. Uh, and then you have cost per unit, and then you have total. Right. Okay. So basically this details exactly what happens. So if you could imagine, right, you have a warehouse. You just have this. Anything on the left side means you have something going in. Anything on the right side means you are selling something. Does that make sense?
Yep.
Okay. So let's just start first, right? So the first thing they gave us was 5th August in the question. Maybe I use a different colored pen. Maybe I'll use... Okay, red's a bit too much. Orange?
It uses white.
No. I'll use blue. I'll use blue. Okay,
Alright.
so 5th August. And... Okay, these are all purchases. So if you notice on the title above,
Right.
it says
Oh,
purchases, right?
Inventory purchases, right?
Yep. So basically any of these entries down here are purchases. So all of these will go into your right side. So on 5th August, you just write 5th August. Oh, it's a bit covered. Oh dear. Okay, wait, hold on. Okay, there we go. Yeah, okay, so 5th August, you write 5th August, then quantity would just be, 30, which is what you bought, right?
Yeah.
And then it costs, okay, they give you straight the total cost. So it's 1,008,
Yeah.
right? Then cost per unit would just be 1,008 divided by 30.
Divide 30, right?
Yep, so that is 60. Right? Yeah, okay, I hope my math didn't fail me here. Right.
You know what? I should get a calculator ready.
Yes, please do.
Yeah, 1,008 divided by 30. It is 60. Your math has 60.
Okay, thank you. Alright. Then okay, this one I believe they say, did they specify? They specified 5.0, right? Okay. They did specify 5.0, but we're gonna try both.
Oh no, they did specify.
Yeah, but we're gonna learn both using this one question.
Okay.
So you make the most out of your practice. Okay. So question 1 will just be me going through. Then question 2 you can practice a little.
Alright.
Okay. Actually, you can actually start filling this in for me. So okay. The next thing you want to actually look out for is the dates at the bottom where they sold tires on
27th August sold
Yep.
tires. And then 11th they sold 30th. On the 27th they sold
10.
10.
Yep, okay. So if you look at the
it's
date,
additional.
5th is way earlier. And you look at the next purchase date. Is it earlier than the first date of sale, first day of sale?
Sorry?
You look at the next purchase date, which is the 10th, right?
10th August.
It is earlier than the
11. Yeah, it's
yes,
11, earlier than 11th.
meaning you have another purchase. So you just record it down. So what do you fill up for quantity?
Quantity 40. Number of tires on the 10th would be 10.
10. Okay.
Yeah,
Then cost.
it will be 650.
Yep. Then what is the cost per unit?
Cost per unit will be $6.50. No, $65. Sorry.
Okay.
Wow,
Yep.
my math is horrendous.
It's okay. It's okay.
$65.
You are allowed a calculator. I hope. Yeah. Okay. So $65, right?
Yeah.
Okay. Then well, you know the what's coming next, right? This first sale. So how many did they sell?
They sold 30 tires.
Yep. Okay.
Tires on 11th August.
It is better for you visually if you could actually add the date slightly lower than
Right.
yeah, basically chronological order from top to bottom.
Right.
Is better for visualization. All right. So how much did you sell?
I sold 30 tires.
30 tires, right? So okay, before you write down 30 here, you look at your whatever you have in inventory right now.
Mm-hmm.
Using first in, first out, right? What was the first thing that came in?
The 30 tires that costed $60.
Yep. So first out, right? You have do you have enough from your first batch?
Yes, I do.
Okay. So then that means you can just sell the full 30, right?
Right.
Yeah, okay, then you fill that up. Then the cost per unit?
Cost per unit will be sold at 60.
60. Okay, then the total will just be yep. Yeah. So okay, you got the gist of it?
Yeah.
Okay, then let's go back to well, purchases. What's the next date?
The next date will be 22nd August,
Mm-hmm.
which will have 1625 as cost,
Mm-hmm.
and number of tires will be 25.
25 and 1600 is cost.
1625 divided by 25. That leaves me at 65 again.
65? How many tires is it?
Yes.
Oh, 1625.
Yeah, 1625. Yeah.
Oh, my bad. Let me just. Okay, 65 again, right? Okay.
Yeah.
Then now that you know that, let's go back. So the next purchase date, is it before or after the next point of sale, next date of sale?
It is before.
Is it before?
Sorry. The next purchase date. Purchase date is after.
After.
Sorry.
Okay, so you have your sale first, right?
Right.
Yep. Okay, then, well, how do you record your sale on 27th?
27th August. Will have sold a quantity of 10
Mm-hmm.
at 65 cost per unit, since the last batch taken in was also at 65 per unit on the 10th of August.
Right. Okay. Depending on how you want to record this, right? You could write a zero sign with pencil or something during exams, because then you can erase it later on.
Okay.
Right. If you don't want to keep track of it in your own head, you could use a pencil and write like the remaining quantity like in small. Then you can erase it later on. That's one of the ways. For me, I just recompute everything.
Okay. Yeah. That's
Yeah.
no worries.
So we sold 10, right?
Yep.
Okay. Then, so I mean 650. Okay, so total of 650, right? Okay. Then, were there any more purchases?
Yes. Purchases. There is another one on 29th of August.
Mm-hmm. So how do you record
30
it?
units. 30 units for 1860. Divide by 30. That will be $62 a unit.
62 a unit. Okay. All right. Then, well, that's it, right? No more activities for now, right?
Yeah.
Yeah. Okay. So then we can go to A. What is the total cost of sales? So for cost of sales, you just look at how much you sold, right? Because these are all cost, by the way. Like these are all cost.
Right, these are all costs.
Yes.
So cost of sales is only the money you brought in, right? After selling the inventory, is it?
No, cost of sales basically means you sold something, right? What was the cost of the item that you sold?
Oh,
Yeah.
okay. Okay, not at what I sold it at.
No, that's the selling price. That's what you call revenue. But
Okay.
cost of sales, you have to deduct from revenue to get your profit.
Oh, okay, okay.
Yeah.
Understood.
So cost
it'll
of
be
sales
1800
basically,
plus
yeah.
65, 650.
Yep. Sorry for cutting you off. So how much is it?
No, it'll be 2450.
Okay, then that is your answer for A.
Okay.
Right, because, I mean, once you draw it out on a table like this and, you know,
It's much easier to see. Yeah.
yep. Oh, okay, then
Okay.
one more question. What was your cost of sale on the 15th of August?
On the 15th of August,
Mm-hmm.
cost of sale on 15th will be 1800.
Yep.
It's before 27th, so I haven't happened
Yeah,
yet.
so if it's 15, it'll be here. Oh, yeah. It'll be on the arrow, meaning that you only take the data from anything above that.
Okay.
Yeah. So if you're working out there and your boss comes to you and asks you on a certain day, you just check. You just check well, usually you have Excel, so instead of drawing pen and paper. Okay, then let's go with what is part B asking for?
Calculate the value of inventory as of 29th August.
29th August. So, okay, it's a bit difficult to understand, but I think what the question is asking is like at the end of the day, meaning that you have like at the end of 29th.
Sorry about that.
Yeah, no worries. No worries. It's fine. Okay, so on 29th, what do you think you have?
Yeah.
Do you have anything from the first batch?
I would assume that out of the entire 95 tires, it'll be after the sales. So as of 29th, it'll be 95 minus off the 40 tires sold, which is 55.
55, but that is not the
But that's not
value.
The cost will be the last three recorded cost, which is 1625 plus 1860 from the 22nd and the 29th August recording.
Okay,
Since
so
we sold at 60 unit from the from 5th, and we sold at 65 from 10th.
right. Okay, so that is one way you can see it. The other way is just you just go down the line. So 30 here, 30 here, they net off to 0. So like with pencil marking, you can say 0 here, 0 here. So what you're left with just these two.
Okay.
Right. So then you just have the sum of these two, which is.
So this is how visualized the tip you gave before turns out.
Yeah.
Okay. So 1625 plus 1860 would come out to 3485, I believe.
Yep. Yep. Correct.
All right. So I meant the calculation though. I mentally calculated that one.
Yeah. So I mean, you could check your own answers to see if it's correct or not. But I believe, I mean, even if it's wrong, the thought process is what actually matters. So as I don't know if they allow you to draw the table during your exam, but I think if you do it, they'll give you the method marks, even if you got it wrong.
For the method mark, they are satisfied with just the equation.
Oh, okay, I see.
Yeah, so they basically just went for A, they just write down tires sold, and you just have to record down the cost of sales down in the equation and calculate it out. They give you the mark for it.
Yeah, okay. So that is the faster method, yes. But it's also more.
That's more clarity, yeah.
Yeah, it's a lot easier to make mistakes with that, actually.
Right.
Yeah. Alright, so that is the first two parts of the question. So far, anything you want to clarify?
Nope. Let's move on.
Okay. Okay, let me just reuse this table. Actually, let me look at the next question first. After valuation, it was discovered that batch of tires. Okay.
I want to show the.
Yeah. Let me just. Let me just snip that part. Okay. I believe this is enough. Where did my mouse go? Okay, there. Okay. So what I'm gonna do now is just replace this. Right. Okay. Hopefully it's visible on stream. Let me check. It's slightly off. Alright. Okay. Okay, so let's just read the question together, okay? After the valuation on 29th, a batch of tires purchased on 29th needed to be upgraded in order to be sold. So this is actually a keyword here. In order to be sold, you need to upgrade. Right?
It was the cost. Well, you mentioned it earlier.
It's said here the net realizable value.
Okay.
And they agreed it to be 1600. Okay, so let's go back to our workings, because it's built on that, right? So let me move this up a bit. Let's see how much I can move. Okay. Hopefully everything is visible here. Alright. Basically they're telling you that well, the stuff you bought on 29th isn't worth as much anymore.
Okay.
Right? And I mean the question is nice enough to just give you the number, which is now worth 1600. So if you look at what you have, right? How much do you actually have from this batch, the 29th, on that you bought on the 29th?
1860 minus. Sorry.
I mean the quantity first. I think it's
quantity.
yeah,
Okay.
30.
30.
Yep, 30 items or 30 units at $62 per unit, which gives you this amount, right?
Right.
Yeah. Okay, so at least you didn't sell any of it, so it's actually easier to calculate from here. So you calculate the revised value of inventory. I mean there are two ways. The honestly easiest method would just be you take the 1600 plus anything else that wasn't that was still in your warehouse. So what is that?
Okay. There'll be 1600 plus 1625, which will be 3225.
Yep. Then that's your answer for C.
Okay.
That is the fastest method because they gave you the number.
It's very direct.
Yeah. So I mean for now it's good enough. And
All right.
yeah, you can just run with that for now, because I think the marks given are not that much for the work done.
There's only 2 marks.
Yeah. Okay, then you need to prepare journal entry to record required adjustment to inventory at 31st. Okay, so this means we have to do debit credit.
Okay. I want to ask, what
Yes.
do they mean by a narration is required?
A narration basically is like a brief explanation of what happened. Because sometimes it's difficult for you to tell what happened just from the double entry itself.
Okay.
Yeah. So, okay, let me just clear up some space real quick. Let Wait, let me see if this. Okay, there's. Okay, the. I think all of these are not needed for now. Okay, so actually all you need for the third question is just these two values that you got before. So you can just like have this and then this the next one. Okay, you just need these two values for part D. Okay, so part D, journal entry. The way I like to write journal entry is just date, your account, and then at the far right you have one debit, you have one credit. Okay. So on 31st, you basically write 31st, 2017.
Right.
Account. Okay, so this was on 29th, right? And this was on 31st. Okay. Did your value increase or decrease?
It decreased.
It decreased by how much?
260.
260, right?
Right.
Yeah. Okay. So then in order to record it, first you need to figure out debit credit, right? So when inventory decrease, do you debit or do you credit inventory?
Credit inventory.
Credit inventory. Okay. Usually when you debit the accounts that you debit, you write above. So this one you credit. Okay.
Okay.
And then well, I'm not exactly sure what the model answer wants from you, but I mean what I'll just write for mine is just impairment loss. And this is an expense. So I mean if you want to be very clear, you'll just be profit, the statement of profit or loss, or P/L.
Okay.
Is to remind yourself that this is an expense account, just in case you have other things to do with it later on.
Okay.
Yeah. So I mean, okay, usually so yeah, once you figure out the credit, it's relatively easy to figure out what the debit is. The hard part is figuring out the first one.
Right.
Yep. So you want to explain how you understand why when you credit inventory it decreases?
I do not. I do not understand why. Could you please explain, please?
Okay. So it goes back to the accounting equation, right? A equals to L plus E. This one, do you remember?
Yeah.
Okay. So inventory belongs to the asset section, correct?
Yeah.
Okay. For me, the easiest way for me to remember any debit or credit, right, is just know liability, credit card. This one, do you understand?
Okay.
When you pay for something using your credit card, you have to pay the credit card later. Right? So it's a liability. You're liable to pay for them in the future.
Okay.
Yeah, so credit card has the word credit in it.
Okay.
So liability, when it increases, you credit.
Okay.
Yeah, the asset would be the opposite. So you debit to increase it.
Debit to impairment loss.
Impairment loss, because it's a P&L item and it's a loss, so it actually flows into your equity under retained earnings. So at the end of the year, when you do entire profit or loss, right? Say if you did nothing and only had impairment loss, because it's a loss, it decreases your equity, correct?
Right.
So if your equity decrease and it's on the same side as liability, you debit it to decrease equity. Does that make sense? This is a lot harder to visualize because
Right, it is.
you don't have the profit or loss. So okay, let's try this. I'm gonna draw out the profit or loss thing on the. So you have statement of profit or loss, SOPL. On the start you have revenue, right?
Yeah.
Assuming you didn't make a single cent for that year, then you blah blah blah. Okay. Your cost of sales will actually appear underneath your revenue, so it can be something. Let's count it as 0 as well. Assuming you didn't sell anything for this year, right?
Okay.
Then this is actually your what is it again? Gross profit, right? That was the word. Okay. And then below you have more like expenses. And your blah blah blah. Then your impairment loss will actually be here under expenses.
Okay.
It could also be under cost of sales. So it just depends on like presentation as well.
Okay.
But usually you write impairment loss below. Yeah. For a more complicated reason in that I can cover in the future. Basically, this amount, right, can be reversed. So it can be reversed. So when you reverse, you do the exact opposite. Like just debit inventory, credit impairment loss. That is if your reversal happened in the same year. So this is very complicated. Let's just not touch it.
Okay.
Yeah. And yeah, I mean, then afterwards, you have just like, let's just, okay, so this one is 260, right? And then this is your profit for the year, right? And you have, I mean, this is negative, so you've made a loss of. Okay, then this one will be loss.
I think you should write negative, right? Minus.
No, for accounting, negatives are just bracket.
Oh, okay.
Yeah. Yeah, loss for the year.
That is rough.
Yeah. Then loss of the year actually makes it into your under equity. You have share capital. Your retained earnings. So your retained earnings could be something. Then you less off your 260 to get the final retained earnings. So actually, let me just equals to something minus your 260 to get something else. You kind of get it now? Since this is a minus, right, it has decreased your equity. Right? Okay, wait, I think this arrow isn't as good. Move it down a bit. Actually, I'll just draw a new one. So a loss will appear in your minus 260 and then it will return back to your equity. So like, this is why I say any revenue and expense at the end of the year, it will just be lumped together under equity as what they call retained earnings. If you learned it before, I'm not sure. Not sure how much you've learned.
I'm gonna be honest. You might as well assume I haven't learned any of this, cause.
Okay.
Yeah. It's been years since I touched POA. This is pretty much all fresh to me.
Okay, that's fine. Okay, then what is your guess of what retained earnings mean? Just from the two words.
It will be from the it just sounds like something from like previous working year.
From
It's like
previous working
profits
years.
from-
Yep.
Yeah. Let's say the previous working year I earned set amount of money, and then keep them under equity, and then it's just that for the current business year to use.
Ah, okay. Right, yeah. So you get the rough idea. So okay, so maybe a little more explanation about what equity actually is, right? The proper definition is just it's not liability. Okay, so the reason why is quite straightforward if you can follow it. Basically, you see a company, right? All of its assets, its building, all that, it all came from somewhere, correct? Like the owners put in money, the company sold bonds to get some money, right? So all these assets, they belong to the company at that moment, but it's shared across everyone who was involved in the building of the company itself. Right, like when you set it up. So for example, if you've run a startup before, you put in $100 or $1,000 into the company, right? Then it'll be considered under share capital. Does the company owe you $1,000?
No.
No, right? So can you call it a liability but for the company?
No.
Yeah, so it's not liability and it's not an asset, right? Because I mean, the company received the 1,000, yes, in cash, but where did the 1,000 come from?
Okay.
Yeah, so it doesn't come from liability, therefore it came from equity.
Okay.
Yeah, so that essentially is how you can classify. Like you look at something, for example, you look at cash, that one is very straightforward, right? Well, what is it?
Cash. Well, I would just put it under something like assets, I guess.
Yeah, okay. So so for definition wise, right? Both asset, liability, and equity, they all have something called history. Basically, they have a source. You can call it source. Right. The second one, which only applies to asset and liability, is future economic
Value.
flow.
Oh.
So for asset, it's inflow. For liability, it's outflow. That one you can get, right? If you owe someone $100, you're gonna pay the $100 back in the future.
Right.
Therein lies in the future.
Okay.
Yep. So what would you do if you have $1,000 just sitting around? What you usually do?
If I was if I have $100 cash, right, and then I want to sell something, I would guess I will buy stuff.
You'll buy stuff, okay? You buy other assets.
Right. Buy like assets that will have more, that bring in more money.
Yeah, so it'll bring in more money, so that the inflow part. And when you owe someone else money, I mean, you know yourself you're gonna pay it back. So
Okay.
yeah. Equity is where the second definition falls apart. Cause I mean, the most straightforward analogy is just if the company earned $100 profit this year, are you entitled to it even if you're the shareholder?
I guess not, because it's still under the company.
Yeah. So, but the company could give dividends, right?
Right.
Right. But is the company obliged to give you the dividends?
No, dividends is not an obligation.
Yeah. So, definition 2 falls apart, correct?
Right.
Yeah. So if they are not obliged to, basically have that outflow. Okay. So these two, right? Sometimes we call it probable. For assets, it's a bit more stringent. In terms of like, basically, I think that's the concept of prudence, even though it's not as like um what's that called? It's not as encouraged because you want to have a fair estimate, right? So by right, you're supposed to say you're supposed to treat asset and liability valuation the same, but I think so far, even though as like they try to do it, I think asset is still more stringent when it comes to estimations. So these are like probable stuff, right? Is estimates. So the easiest analogy I can think of is say you lend someone $1,000, right?
Okay.
Do you know for sure you're gonna get $1,000 back?
No, it is. I expect them to, but doesn't mean they will pay me back.
Yeah, right. So therein lies, right? You
Right.
expect them to pay you back, but you don't know for sure. But
Right.
if you say you borrowed money from like a bank or something,
Right.
and I mean, yeah, then you definitely have to pay it back, correct?
Right.
Yeah, so it's something like that. The probability is a bit wonky at times, but you could kind of understand it as this at a basic level.
Okay.
Yeah.
So basically,
Mm.
it's not guaranteed. It's not guaranteed. Let's say you loan out money, it's not guaranteed to come back. Is it all considered? Is it only considered if there is a chance you won't get it back? So let's say if I loan money
Mm.
to let's say something else,
Mhm.
and if I loan money outwards,
Mhm.
and some way somehow I'm guaranteed to get the money back, is it still considered a liability? Like if let's say in this scenario, some way somehow I'm guaranteed the money back.
You're guaranteed the money back, right? Then
Yeah.
I mean it's still an asset. Uh, so what you're referring to is what they call accounts receivable.
Okay.
Basically, or you can call it trade receivable. I think that might be a more familiar term. These two are slightly different, but at the basic level, you can understand it's the same. Basically, in the ordinary course of the business, like when you're doing the business normally, people usually can't pay fully in cash,
Right.
right? Because it's not efficient to just have cash lying around.
Right.
Yeah, so usually people put it on a tab where, let's say, oh, I'll pay you later, right?
Okay.
So if you know you're gonna get, like, you're 100% certain you're gonna get it back, then you value it at 100%.
Okay.
So 100% value. If you are not sure, you give an estimate. So for example, oh, there's a 70% chance you can't pay me back. Then you'll be valued at 70%, right? So this is where professional judgment comes in, and also a bit of data analysis. So you can kind of tell, like, how the companies usually keep track of is like they keep track of a whole list of their debtors, and then they just say, oh, based on historical data, after a certain number of days where the guy didn't pay me back, is lost. Like, he's never gonna pay you back.
Okay.
Yeah, so that's what the basic of it is. Basically,
Okay.
yeah. But this is more of estimates, which is a more advanced topic.
I think an example I can think of in real life would be paying for something in installments.
Installments is slightly different, but uh you could think of
Like
it that way, yeah.
okay,
Hmm.
maybe installments is not the best. Let's say you're subscribed to a plan, say a yearly plan, right?
Mm-hmm.
And then they expect, let's say Anytime Fitness expects $100 a month, and then they expect you to subscribe for a month, a whole year, and then you sign up for the yearly plan. You go, let's say the first 6 months, and you pay the first 6 months.
Hmm.
But then starting on the 7th month onward, you still go. They still give you access to the gym, but you don't make the payments. So would that be a accurate like adaptation of what's like just explained?
Well, then on the gym side, they will actually keep track of like the number of people who does that, and the moment someone actually subscribes to that, they would already say, oh, there's this percentage chance that I'm not gonna make that money back, or like he's gonna default on that. So usually these sort of estimates are done at the start, and they get revised as things progress.
Okay.
Yeah. So you'll see it later on when we go into or other assets like, you know, accounts receivable, trade receivable, this sort of things. But for now, these are actually above intermediate level stuff.
Okay.
Yeah. But I mean, those are good questions. It means that you're thinking about the possible implications.
Okay.
Yeah. But for now, do you understand how you classify assets, liability, and equity?
Yeah.
Yeah. So for equity, you can't even tell. Like, it could be zero. It could be anything.
Okay. Interesting.
Yeah. Okay. Then
Back to the question, right?
yeah.
Back to the question we're working on. Under the general journal, because on the answer sheet that I have, it says impairment loss on inventory. That's debited 260, and then being impairment loss on inventory recorded is credited 260.
Okay.
It is basically what you have written down, except it's not just inventory and then credited.
Yeah. So okay. Your narration, right? Usually, okay. I forgot about narration because it's been a while.
The narration will be inventory bracket 1860 minus 160. That will basically.
That's just the calculation step.
No. Oh, okay.
I think the being something like the being impairment.
Loss.
Yeah, that one is the narration.
Okay.
The other one is your working step, like the first line.
Okay.
Inventory. Okay, another way you write it is accumulated impairment loss on inventory. Then the first one will just be impairment loss on inventory. Like if you want to spell out the full account name. Why accumulated impairment loss is because you want to keep track of number one, the specific impairment, because it makes sense, right? You can't impair below your full cost. Like you can't impair to have negative money. Like if you think
you can't be paying more money for something you already bought for, you already paid full price for.
Yeah, correct. So this is why accumulated, right? It's important to, well, I mean, at basic level, I think it's fine. But as you go higher level, it's good practice to write accumulated impairment loss on inventory.
Okay.
Yeah. Because then you have a separate account that keep tracks of number one, exactly how much is impaired for each like item. And number two, when you reverse it, it's a lot easier as well. Right.
Okay.
And number three, you have, you kind of can tell whether or not an item is fully impaired, meaning that, it's the accumulated impairment equals to the cost of the good.
Right.
Yeah. So these are the three benefits of writing and creating this account. And where this account actually goes, right, is you have an asset, right? Okay, let me see where I can. I'll just erase this for now.
Yeah, sure.
Yeah. Oh wait, I realized you're not seeing anything.
No.
Are you watching? Oh, okay. Okay, my bad. I should have set up the video feed as well. Okay, so you have like under your assets, this is your statement of financial position, SOFP. You have your assets inventory, right? Then underneath it, you have less accumulated impairment loss on inventory. So you have like what's the amount up there? 3485. And then you have less 260. This is how you write it. And then you just have 3225. You can call this net realizable value or NRV. I think it's fine. Yeah. So this is what they mean by valuing at the lower of the two, because if you don't have accumulated impairment loss, your net realizable value will just equals to the cost of inventory. You get it? Oh. uh okay, so some technical difficulties. My friend's PC crashed. Okay. So, I mean, for those viewers at home, just a quick heads up. Some of these concepts have not been covered yet and will not be covered for quite a while because, as I said before, it's intermediate stuff. So, two options actually. You could either wait for me to eventually cover it, which will be quite a while later. Or if you have something urgent, you can always drop by the stream and ask me. I think the best channel for questions will actually be Google Form, where you can upload your questions per se. Yeah, I think that might be the best option. I'll just set up a Google Form. It'll be on, I think, YouTube and Twitch. I'm not sure if I can put it on Twitch.
I apologize.
Welcome back. No worries, no
I
worries.
decided to give up on me.
Yeah, no worries. Hey. Yeah, so wait, which part of my explanation did you last, recall?
It was. Wait, fuck. I think my brain short circuited. Hold on. I remember till it was.
Yeah.
When you just erased off the.
Okay. I see.
Yeah, when you just erased off the area.
Okay, so okay, I'll go through it again. Okay, so in your balance sheet or your statement of financial position, right? You get you list out your assets, correct?
Right.
Yeah. So if you look at your stream, right, the blue color ones will be will be what I'm talking about. So first you have inventory, right? The cost of it would just be this, right? Then you less off any accumulated impairment loss on inventory, which is like up here. So this will go down to here. So you less it off. Then you get your net realizable value at this amount.
Okay.
So this fits the description, the definition of, how you do costing for inventory. The lower of your net realizable value or cost. So if your cost, if you have no impairment, right? If your impairment loss is 0, your net realizable value would just be 3485. Right? So you see it? It's the lower of the two. If you have no impairment, you can't really have a negative impairment.
Right. Okay.
Yeah. Accumulated impairment, yeah, usually you should never see a positive value in it. That means a debit balance. Yeah. So, I mean, so far, any questions?
So far I'm good.
Mm.
Yeah.
Okay. Yeah, so then, I mean, the last two parts are just explain what is meant by net realizable value.
All right. No worries.
This one you can just refer to the answers, right? Definitions isn't really what I memorize, so I can't tell you
There's
the
no worries.
exact.
There's no worries.
Yeah.
I think as long as I can get the grasp the concept behind each entry,
Mm.
the 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 definitions is kind of secondary. Yeah.
Okay. Then, I mean, okay, accounting theory, which is applied when valuing inventory. Valuing. I mean, that one you can also refer to the book's answers.
Okay. On the answer sheet,
Yeah.
they have written down prudence theory.
Ah, okay. So yeah, I did
so
say
yeah.
it out loud. Okay.
Yeah.
I wasn't sure, so yeah. Okay. Prudence.
Then,
Let me just explain what prudence is, real quick. Do you understand what it is, or you want an explanation?
No, I have no clue.
Okay. All right. So prudence just means when something bad happens, you assume it has a greater impact than like the positive outcome. Basically, when you're presented with two scenarios, you usually take the worst option if they have like similar probability.
I don't get it.
Okay, so for example, you have your box of toys, right? They are worth $10, right?
Mm-hmm.
When the market value is $20, so I mean your toy is originally $10, right? If your market value is $20, you still value it at $10, right? Okay, wait, maybe this table isn't the best. Let me see if I can. Okay, you can still see on stream. Okay, so all right, I'm just gonna use the top one as the. Wait, are you still there? Oh no.
No worries, no worries. Take your time.
Oh, okay. Oh no, I thought you were gone again.
Nah.
Okay.
Yeah, right.
So when your market value is $20, right? You still value at $10, right?
Right.
Because of the definition. But if your market like if you can only sell it for $5, suddenly your value becomes lower.
Right.
Like
You always take the lower end of it.
yeah. So usually this is okay, I mean this is the gist of prudence basically.
Okay,
When
so basically just be pessimistic.
Yes, just be passive, correct.
Okay.
Yeah. So just because you can sell it at $20 doesn't mean that it is worth $20.
Okay.
Yeah, until you actually sell it.
Okay.
Yeah. So toys, I mean, in inventory, I think this is the distinction here. So when you realize it, then of course you can say that, oh yeah, I did sell it for $20. I made a profit, right?
Right.
Yeah. So, okay. Even more distinct way of seeing it is through profit and loss. So I'm just gonna delete this part for now, and I'm gonna move this up. Okay. So same scenario, right? You have you already bought $10. This was like past event.
Right.
Say you didn't sell anything, right? No sale. When the selling price is $20, but you didn't sell anything, revenue 0 because you didn't sell anything, right?
Right.
Your cost of sale will also be 0 because you didn't sell anything. And your expenses, assuming you're just a shell company and does nothing, 0. So you have no profit or loss, right?
Okay.
But even when you didn't sell here, your revenue still 0. Your cost of sales also 0 because you didn't sell. And your expense becomes impairment loss of $5, 10 minus 5. Suddenly, oh, okay, wait. Yeah. Suddenly you have a loss. Even though you didn't do anything.
Right.
Yeah. So when the market looks up, you can't say, oh yeah, my products, even though I didn't sell it, it's gonna increase. So I record a profit for myself. No. That's not how it works.
Okay.
But when the market goes down, you say, oh, yeah, you have to record it immediately. Yeah, that's prudence basically.
Okay.
Yeah.
But it's not okay.
Mm.
So even if it doesn't, even it's not realized loss,
Mm.
it still have to be recorded down as a loss.
It will be recorded as an
Okay.
expense.
Okay.
Yes.
Interesting.
Unrealized loss is something else. Unrealized profit, unrealized loss is different. It is when say you have signed a contract, right? Okay, usually this is for like construction companies.
Right.
You sign a contract that locks in a price at a certain date, right? And you realize later on that you couldn't fulfill, or like your cost is gonna be higher than what you would ever have earned from the contract. That is unrealized loss. Meaning you know that there will be a loss ahead. And you just record it as such. Like you just record it as a loss.
Okay.
Yeah, but it'll be unrealized loss. So eventually you realize it fully and then yeah, you'll be
That one. So what? That one is kind of like trend reading kind of stuff.
no, as in you how do I say? Say for example, you're a construction company. You say you construct this building for $10,000. I'm not gonna write this down because it's very advanced topic.
Right.
For $10,000, right?
Uh-huh.
And as you start building, your cost suddenly exceeded 10,000. But you already signed that the guy will pay you 10,000 only. So you record the rest as unrealized loss because you haven't received payment from the person yet.
Okay.
And when the person pay you, you just like, oh yeah, I just suffer a loss.
Oh, okay.
Yeah, it's a different concept. Yeah.
Okay, I understood.
Yeah, I mean, unrealized loss could be a lot of different things as well. I could be wrong on this, but yeah, this is not really unrealized loss. Yeah.
Okay. Interesting.
Mm.
Wow, so many things are like so fresh. So
yeah, but I don't think at O levels you'll be covering anything like that.
No,
Yeah,
I don't think so.
I don't think it is. I don't think it's that advanced. Because what you're saying is like touching on uni stuff already, so.
Oh shit.
Yeah, good luck.
Oh my.
Yeah, but okay, for now, I think prudence is still a big thing for you guys because I think they want to instill that. Because what happened last time was, okay, this is a bit of like storytelling. Was just that companies, right, would overstate their profits, would overstate all their like their value basically, which hurts everyone involved, including themselves, because people buy into them, right, thinking they will make money from it. But in the end, the company cannot sustain it, and the company goes bankrupt. So company dies, and the people basically fall with the company. So it hurts way too many people, and that's why the accounting principle is as such.
Okay.
Yeah.
That is actually okay. That's actually very interesting.
Yeah. Accounting is, well, I mean, there are fail safes inside, but it's never foolproof. So that's why, like, honesty, I believe integrity is a huge part in if you learn accounting. Being
honesty is thy best policy.
Yeah. I mean, honesty is one, but I think integrity goes beyond that. Yeah.
Okay. This is fun.
Yeah, I think. I think this is long enough for one lesson. To be honest.
An hour and 15 for one question. Let's go.
Yeah. But
Okay.
yeah, this is this is usually how I do.
We were very thorough with this question.
Yeah, of course. It's best to understand everything at the start
Yeah.
and clear out every misconception.
Because I remember before when I did
Mm,
POA, right? Cost of sales would confuse me. This term would confuse me like
mm,
super hard.
mm,
Because I always thought it would be like uh it would be something along the lines of, okay, this is what I bought, this is what I bought it as,
mm-hmm,
and even if I sold at a loss, then I record it as the original value of it.
mm.
Something like that. I don't know. I would just like make some random stuff out about it to myself
I
and
see.
guess like my stuff that is correct.
Mm. Okay, so
But no, I'll just use a
yeah.
different a wrong reporting program.
Mm. Okay, I think it's also good to introduce to you a few other accounting concepts. So
Right.
you remember just now, in my like here, I did say that revenue and cost of sales goes together, right?
Yeah.
This is basically the matching principle.
Elaborate.
Basically, you match a gain, right? Any gain with a cost. Because you can't really gain anything for free.
Right.
Yeah, nothing is truly free in this world. There's always a cost to it. Even donations, there's still strings attached.
Okay.
Yeah, things like that. It is, you can't really quantify it most of the time, but in accounting, at least we try to do it as much as possible. So, revenue, if you can, it's, you will associate with a gain, right? Correct?
Yeah.
Cost of sales will just be the cost. So
Okay.
when you make a sale, you think to yourself, oh yeah, I sold this item. How much did this item cost? Right? Usually that's your next step of thinking.
Okay.
Right? So that's what
Does
they
it
mean by
does
yep.
it have to balance out? Like,
No,
I mean balance out as in like
it
close
need not
to
be equal.
or okay.
Same thing, your gain can be lower than your cost. You make a loss.
Okay.
Yeah. But the important part is you need to match it. Basically, you need to tie it to a certain something.
Okay. This is called matching theory, right?
Matching principle.
Matching principle.
Yep.
Okay.
Okay. I think these are the two main ones, like the prudence concept and the matching principle. This is more of a concept.
Okay.
Because principle is like something that we follow by as much as we can. What we call substance over form.
Okay.
Basically, we look at the transaction as a whole. Basically we dive a bit deeper to understand what that transaction was made for, what are the implications before we actually come to a conclusion, whether or not to make a certain judgment.
Okay.
I think this is the primary one, to be honest. Everything revolves around this. If you can, you try and remember this. The questions will never ask you about this, but as an accountant, this is good.
It's a good thing to like build around.
Yeah.
Okay.
Mm.
Interesting.
But okay, so today you learned about prudence. Matching will come out a lot later, but matching is important.
Okay.
Substance over form is just a good life lesson, to be honest.
Okay. So today
Mm.
I've learned how to figure out cost of sales.
Mm-hmm. So what are the
And,
two? What are the two accepted across the world methods?
Accepted across the world methods, as in like the accounting methods, right?
The costing method. Basically, how do you calculate?
How do you calculate?
Mm.
FIFO.
Mm-hmm. First in, first out.
And I believe it is the weighted average.
Yep.
Okay.
Wait, let me.
I have have a memory of a goldfish. I'm surprised I got this.
Yes. Oh wait, we didn't cover the weighted average. Okay, we can do it some other time.
You kind of described.
Oh yeah, I
before.
did. Yeah. I didn't go through the full thing, but the same
Right.
thing with the table, just a bit more complicated.
Okay.
First in, first out. Then you have weighted average. And then for our friends in the US, you can plus last in, first out. It's the same. It's just the same table that I drew just now. Just that you throw out whatever you
Just
bought.
flip it.
Yeah, you just bought whatever you bought recently. You throw it out first. Yeah. Okay. Alright. You know what? I'll make this as a supplementary video. Probably over the weekend. Cause now I'm busy.
some delayed action.
Yeah. I think like back then I did the supplementary videos on the day of recording, but that was because like I wasn't working. I wasn't working. Yeah, okay, but weighted average is, it can either be more complicated or easier. Depends on how your brain thinks. But
for me, I think FIFO is much easier.
Mm.
Because, FIFO would be much easier because
yeah.
I worked in fast food for like
Okay.
for so long, and is like the concept of first in first out.
Oh yeah, it's very pronounced there, isn't it?
It's super just engraved into my bones.
Okay. Then average, weighted average. How about this? Tomorrow? No, tomorrow I can't. Saturday afternoon?
Hold on, today's Wednesday, right?
Yeah. Or Friday night. I could sacrifice some of the gaming. Yeah, so you know what? Friday night, unless you're busy.
I'll tell you what, we'll do Friday, and then we can game all of Saturday.
Sure. Of course. Alright, so any last questions that suddenly popped in your head?
I think I'm good today.
Alright.
1.5
Yeah,
hours
it's a lot of information to take in. But I mean, it'll be in a VOD, so if you want, you can watch it back.
The entire hour, I've just been eating something. I've been eating the entire shit.
That's fair.
But I need a physical stim for me to like process information, and the best for me is just eat, it's just munch.
Man, gum would be great for you, huh?
It would. Honestly would. I'm putting on so much weight today.
Oh no. Man.
Alright.
Yeah.
Let's call this.
Alright. Yeah. Thank you very much for being such a great student.
Thank you so much. I've learned more about this than I have in secondary school.
Oh man. I'm just glad that you managed to learn something today. Alright. Yep. See ya. Alright. Where is my Discord? Okay, so yeah, that concludes our lesson. A lot longer than what I expect, but to be honest, I think I would sacrifice duration for proper explanation, and hopefully you get learn something from this. And again, I apologize if some of the concepts that we covered today are more advanced than what you're learning right now. Because yeah. And okay, some of the higher level stuff, I will admit, might be wrong. So I think it is also best to fact check whatever that whatever that I covered. For the basic items like GAP, last in first out, weighted average, these sort of basic concepts, I believe I'm okay. But if you're not sure, always ask someone who is actually trained to teach, trained to be accountants. Yeah. I see this more as a blind leading the blind. A less blind leading the blind kind of situation. but going through all the accounting training that I did before, this was how I understood it. It could be wrong, could be misplaced, and if it was, well, actually, feel free to correct me if I'm wrong. Like everyone else who might be watching this back, I am still learning, and really I hope that through this experience we all learn together instead of just a one-sided kind of thing. But other than that, well, I think I've yapped for quite a while now. Yeah, once again, I'll set up a Google form on YouTube, Twitch if possible. So feel free to drop more questions in. In fact, I think my friends' questions have not even been fully covered yet. And I will do up a supplementary video on last in first out, because unfortunately that is not recognized under the international financial reporting standards, but it is recognized in the US as a generally accepted accounting principle. So yeah, I think for those who are watching in the US, feel free to use the supplementary video to help yourself out. Uh, because it might be tested. I actually do not know what the exams are like over there. But yeah, other than that, I will see you all on Friday. I believe it's the 5th of June. Let me check. Yeah, 5th of June. 12 p.m. UTC. Yes. Other than that, thank you so much for watching to the end. Usually actually I will just end it here. Take care.